So tonight we're going to be talking about moving averages, what they are, what they do, and how to use them in our trading. So what is a moving average? So the moving average is going to be the average price over a period of time. So for example, if on a daily chart, the 200 moving average will calculate the average price of the last 200 trading days. So it's plotted on a chart bar by bar, and it forms a line that moves with the average value. And these moving averages can act as strong support or resistance. They will act as areas of interest in a chart, and they are going to show us the momentum and strength of a trend. Some of the pros about moving averages that you can view the momentum. So whatever moving average price is respecting the nature of the current momentum. And it gives us a clear bias. So my rule is I'm only going to look for long stocks, or I'm only going to look for longs above the 200 MA and only short stocks below the 200 MA. And we can use moving averages as targets and stop losses. And the best part about the moving averages is that we can actually maximize our reward while minimizing our risk. So we can ride a stock until momentum dies, visible through the moving averages. So the cons of moving averages are they are a lagging indicator. So moving averages calculate past price action. So the information is behind the current price. So in some cases, moving averages may give false signals after the move already happened, but that's for like on larger time frames and stuff. Lower time frames too, but I'm going to show you how to kind of get around that. So the 200 SMA. So this is our most important moving average on a chart. So both bulls and bears will see this as an area of value. So here is the 200-day moving average. So this is this red line. So you see how price is respecting this red line, this 200-day moving average. So this is the average price over the last 200 periods. So if you're on a 1-hour chart, it is the past 200 hours. If you are on 5-minute charts, the past 200 5-minute candles. And this can act as strong support or resistance. See how each time it comes back into the 200 MA, it actually bounces off of that area. So the 200 SMA is the most important moving average, especially on the daily chart. So this is perceived as an area of value. So in an uptrend, this is kind of your last line of defense. So you'll hear people on Twitter or people on the news and say that so-and-so has officially lost its 200-day moving average. Or they'll say, it's all about the 200 SMA right now. So as we can see, each time price comes back into this 200-day moving average, it respects it. So the trend is respecting the 200-day moving average. That is important. So this is the weekly chart on the S&P 500. So the S&P 500 has respected the 200 SMA for nearly a decade. So you can see it sometimes goes below a little bit, not by much. See how it broke down and then actually acted as resistance, broke above, then the 200 SMA acted as support. Okay, that was in like 2011 to 2012. Fast forward to 2016, it revisits the weekly 200 SMA. It bounces off of it. Okay, fast forward to 2019, revisits the 200 SMA, bounces off of it. And then in 2020, it went below, but then it kind of scooped right back up and bounced off the 200 MA. So here's the Amazon daily chart. As you can see, it pretty much respected the 200-day moving averages. Here it gets a little funky, but typically, as long as the trend is still intact, the long-term trend is going to respect the 200 SMA. So it's been respecting it since 2015. So how do we use this? Okay, so remember we said is an area of value. So when we have the 200 SMA and price revisits the 200 SMA, we can actually look for that pullback trade. So you, in an uptrend, you want to look for pullbacks to the 200 SMA. So here we got that kind of hammer candle off of 200 SMA, and that could have been our trigger to get us in the trade with our stop slightly below. So you always, just like any kind of trade, you always want to confirm with candlesticks. All right. This says as a quote from me, but I've heard this from, dozens of people. Never buy a stock below its 200-day moving average. So gravity will always be working against you. So if the price is below the 200-day moving average, the sellers are in control. So gravity from the selling pressure is working against you if you are trying to get long. All right, so when the faster moving average crosses below the slower moving average, it is considered bearish. Hold on. That's not wrong spot. Anyway, so 200 SMA 15-minute on Amazon can also act as resistance in a downtrend. So see, we're on our 15-minute chart. Each time it revisits this 200-day moving average, it acts as resistance. So not to say that there aren't long setups under this 200 SMA, but I would probably not go as heavy on them. Or if you do take a long setup, your target or your biggest resistance is going to be the 200 SMA. All right. So when you are below the 200 SMA, you only look for short opportunities. So here we have our Amazon chart again. We have support here, touched once, twice, 3 times, broke below, and then came back to test former support, now new resistance. So what gave us more confidence to take the trade, other than the obvious, SR flip, is that we're actually below the 4-hour 200 SMA. So we know that gravity is working against the buyers when we're below 200 SMA. So the 50 SMA is the first line of support in an uptrend and the last line of resistance in a downtrend. So see, remember how you're waiting for that pullback to the 50 SMA? What about all this stuff in between? Are you just not going to take a trade for months? So that is where the 50 SMA comes in handy. So the 50-day simple moving average. So this is the S&P. It's actually been respecting the 50 SMA. Now it's not going to be perfect. Sometimes it dips below, but for the most part, it is following this trend. So that is the best use for moving averages. So the 50 SMA is the medium-term trend. So as long as we are above the 50 SMA, we know that the stock is in an uptrend. So we can use the 50 SMA for dip buy opportunities as well. So if we don't want to wait for revisit to the 200 SMA, we can look for other opportunities at the 50 SMA. So this is the UPS chart. So each time we bounce off the 50 and come back to it, see this hammer candle, see this hammer candle. So those are possible dip buy opportunities. So basically you look for a revisit to the moving average and then wait for your bullish engulfing, your hammer pattern, piercing line. So if you're a short-term swing trader, this could be a good strategy for you. So go to your daily chart, look for revisits to the 50-day moving average. So when price is well above the 200, so see the 200 here, price is way the heck above the 200-day moving average. So that's when we put the 50-day moving average on. So we'll look for pullbacks there. So we know that if we're above the 200 and above the 50, we are in an uptrend. So not only is that observable through market structure, higher highs and higher lows, but through the moving averages as well. Here's kind of a cool technique. So if you're looking for pullbacks to the 50 SMA, say you broke above the 50 SMA right over here, you're looking for that pullback to the 50 SMA and you want something to kind of confirm it. So you want to look for our beloved candlestick pattern. So we have our dragonfly doji right here. So that is going to be what gets us in the trade. So that's where we can take our pullback entry and then we can add more when it breaks above resistance and retest. So we can add more here. And then what you do is you can hold as long as the 50 SMA is holding. So as long as this 50-day moving average doesn't get a candle close below, you're good to hold. See here how it dipped below, but it didn't close? The candle closed actually above. That could have been another buy, who knows? But here, you see how the candle closed below the moving average? Then we can get out. So in a nutshell, the technique is you want to wait for price to break above the 50 SMA. You need to make sure that you're above the 50 and the 200. And so what do? You wait for that pullback to the 50 SMA and you wait either for your dragonfly doji, your hammer, piercing line, morning star, or bullish engulfing. Those are the candles, potential candlestick patterns. And then if you get one of those, then you go long on the next candle when it goes above the previous candle's high, and then you ride it until you get a daily close below the 50 SMA. So that is the benefit of riding the trend with the 50 SMA, because we know that the 50 SMA means there's short-term strength or medium-term strength. Above the 200 SMA, long-term strength. 50, medium strength. So that's a great way to hold your runners. Right, and also works on lower time frames as well. So here we have our Tesla 5-minute chart. And so we actually have our 50 SMA right here. For me, 50 SMA is always going to be yellow or orange, and then the 200 SMA is always going to be red. This is a personal preference of mine. That's usually how most charting services make it anyway. So here we have a rejection of the 50 SMA. What do we have here? Gravestone doji. You could call it shooting star, doesn't matter. But that is going to be a good entry. The candle next below the gravestone doji low, that's going to be a good short opportunity. And then what can you do? You can ride the stock until it closes above 50 SMA. And here we had a channel. So we know that the top of the channel is going to act as resistance as well. So that gives us another reason to take the short. So in essence, wait for it to break below 50 SMA and then return and then see if you get some kind of bearish signal to go short. Here we had another one. So here we have a bear flag. So we get a strong move to the downside after this initial downside move. And so we actually have a rejection of the 50 SMA and the bull or bear flag pattern. So that's kind of a no-brainer trade right there. And then aim for like 2 or 3 R, meaning your reward is double your risk. All right, so when price is below both the 200 SMA and 50 SMA, only look for short opportunities. So here we had this rectangle under both moving averages, broke below this low. And so that was going to be what gets us in the trade. But we know that's not really a moving average trade, but we can use the moving averages to our advantage to know where is the strength. Is it on the buy side or is it on the sell side? Who's in control, buyers or sellers? Okay, another example. Okay, we're below both the 200 and the 50. So what do we look for? Pull back to the 50, right? So what do we get here? We get a 4-bar play. 1, 2, 3. Fourth bar gets us in the trade. And then the rest is history. That's a 15-minute chart, by the way. All right, here's SKLZ daily. What a dumpster fire. It's the same situation here. So check, we're below 200 and we're below the 50. So we have a descending triangle right here. That's going to add to our confidence to take the short trade. And eventually we pull back to the 50 SMA here on the daily. And then that can also be a bearish signal because often the 50 SMA and the 200 SMA are going to act as resistance. When we acting as strong points that every trader has an objective level in the chart that they can see, that's going to act as an area of interest. So this is a 5-minute chart of IWM. All right. So look for those pullbacks to the 50 SMA. So here we have a hammer off of the 50 SMA. And I like it when it kind of undercuts and then goes back above it, because it shows us that sellers try to take control, but then buyers push it up to the high, to close at the highest of the day. And then you can aim for the swing highs up here. Same situation here. You wait for that pullback to 50 SMA and try to go for a short. And then you can use this imbalance right here, this FVG from this candle high to the third candle's low. You can use that as a target, or use 2R. When in doubt, use 2R. So take your tool and then you draw your risk 1 to make 2. So essentially, the 50 SMA is going to be your first line of support in an uptrend and the last line of resistance in a bear trend. And the 200 SMA is going to be your long-term trend. So if the 50 SMA is the medium-term strength, the 200 SMA is going to be the long-term trend. So only go long if above or below, or short if below. So this is the last line of support in an uptrend. So once you lose the 200 SMA, that's not a good sign for bulls. All right, let's talk about the golden cross. What is the golden cross? When the 50 SMA crosses above the 200 SMA, traders will see this as a very bullish signal. We call this a golden cross. So here we have our 200 SMA in red, and we have our 50 SMA in orange. When the 50 crosses up above the 200, that is your golden cross. So that is going to be a bullish signal. So you're going to look for patterns around there. Just because a golden cross doesn't mean that you need to go long right away, because it is a lagging indicator. So what you could have done, you could have waited for this channel break and played that. So you can sometimes look for patterns before the cross actually happens, because you know that the cross is actually kind of a lagging indicator. So here we're on AMD 1-hour chart, or we could wait for our pullback to the 50 SMA. So we have a bullish engulfing candle here, right below the 50 SMA, and then it closed back into above the 50 SMA, and then that is your trigger to get in the trade, and then you ride price until it closes below the 50 MA. So this is actually a 50% gain on commons, which if you guys play options, you know that those gains would have been unreal. This was just a beautiful setup. So watch for that pullback to the 50 SMA. Don't pull back blindly. So wait for a bullish candlestick pattern to appear. Here's another example of a golden cross. So this is our Tesla weekly golden cross. And so when the 50 SMA here in the yellow crosses up to 200 SMA, it's known as a golden cross. And then we can look for long opportunities. So we have resistance right here. So we broke out above resistance and then retested. So former resistance is now new support after the golden cross. And then we have a hammer candle at that SR flip after a golden cross. So what's stopping you from getting in this trade? And then, so what's the technique? You ride the stock until you get a candle close below the 50 SMA. So if you had the patience for this, because keep in mind, this is a weekly chart. So this is from 2020 all the way to 2022. You can hold for 2 years. This Tesla trade would have netted you 759% profit. And I know it's Tesla, so, not every stock is going to move like that, but that's the technique. That is the picture perfect setup. So once you have that golden cross, you know that momentum is shifting to the bulls. So when the 50 crosses up to 200, it's that shift in momentum. So you want to look for setups. You don't want to just blindly buy the golden cross. Right, here's another golden cross. This is Riot Daily. So here's our golden cross right here. And then what do? You buy the 50 SMA pullback. And then you ride it until you get a close below. Now this trade didn't net that much, but it wasn't a loser either, right? So sometimes you'll make a little bit, sometimes you'll make a lot, sometimes you'll lose. So I want to show realistic trades. Not everything is like Tesla where it goes 759% in only 2 years. So death cross. Death cross is the opposite of a golden cross. So when the 50 SMA crosses below the 200 SMA, traders will see that as a very bearish signal. Now, back when the S&P death crossed earlier this year, everyone was trying to buy the death cross. They said, oh, that's bullish. But you got to think, would you really buy something with the name death in it? Doesn't seem very smart, does it? Look at him now, holding the bag. So here's our death cross, AMD 1 hour chart. So when the 50 crosses below 200, when yellow goes below red. So it's the same technique, but opposite. You look for that pullback to the 50 SMA, or you look for potential setups. So here we have our death cross. Maybe you could have shorted somewhere in here, but for the purposes of this lecture, let's look what happens when we get our return to the 50 SMA. So we got a bearish engulfing candle right here. So that is our short opportunity. So don't short the death cross as soon as it happens. Wait for some kind of pullback to the 50 SMA. And then you can aim for 2R, or you can use a technique where you ride the 50 SMA. It's up to you. I think as a new trader, 2R probably easier because you're not going to have patience to hold through all this. Then you just put your stop right above. It's not, it's a very simple technique. So death cross, look for bearish pattern, either shooting star, gravestone doji, bearish engulfing, dark cloud cover, evening star. All right, here's our Roku death cross. All right, so we don't really want to get involved anywhere in here. But once we get the death cross right here, we pull back to 200, or to the 50. And then what do? Then we can kind of take a stab at a short entry. We can maybe take some profits here, or maybe when it breaks below the support, maybe we could even add. And then it kind of retests over here. And then it retests 50 SMA over here. So if you follow the technique to a T, you would have got like 80, 90% off this trade. Do you know how bad Roku just kind of went in the dumps? It just like absolutely went to garbage. See, it's like up in 350s over here. Now it's at like 80s, 90s. So that would have been a huge gainer if you had followed that technique. All right, so yeah, we wait for the pullback, 50 SMA, can add when it breaks below support, and then retest that break. Right. So when the death cross happens, it means that momentum is shifting to the bears. So the sellers are gaining momentum. They have become in control. So you're only going to be looking for sells. Okay. All right, here's another death cross. So when the 50 goes below the 200, come back to revisit the 50. You got your short entry at the shooting star, 50 SMA rejection. Another possible short entry here at the bearish engulfing candle at another 50 SMA rejection. Hanging man at the 50 SMA. So you're just looking for simple candlestick patterns after the death cross at the pullbacks to the 50 SMA. This is for 15 minutes. I think the hardest part is going to be knowing which time frames to use. So me personally, I always keep SPY 1 hour, 250 SMA up. I like 5 minute as well. And then I'm always observing the daily 250 as well. So as a general rule of thumb for crosses, when we talk about crosses, when the faster MA crosses above the slower MA, it's considered bullish. So here we can use a 20 SMA as well. So that is a shorter term shift in momentum to the bulls. So when the 20 crosses up to 50, we can take that as a bullish signal. Okay. Here we have a trend break, and then we have our 50 SMA and our 20 SMA. So when the 20 crosses up to 50, that is our bullish signal. And then when the faster moving average crosses below the slower moving average, it is considered bearish. So if we have a 20 crossing a 50 below, that is bearish. Okay. Now, different stocks are going to respect different moving averages. As a rule of thumb, 50 and SMA, 50 and 200, you're pretty safe with. But I'm going to show you the other ones here in a second. Here we had Tesla bearish 2050 SMA cross. As you can see, that is at the point where momentum shifted to the downside. Right. So exponential moving averages, they take into consideration more recent prices. So you have SMA, which is simple moving average, and then EMA, which is exponential moving average, and that considers more recent prices, like I just said. Is any one really better than the other? I think for 50 and 200, use the SMA just because it takes into consideration past price action more. But then for day trading, when you're using like 9 EMA, 21 EMA, 5 EMA, use EMAs because for the short-term momentum moving averages, you want more recent price action to be more weighted. So when we talk about the 5 EMA, that means a stock is very strong. So the force is extremely strong with the stock if it's respecting the 5-period moving average. The 9 EMA is very strong as well. This is short-term momentum. So that's going to show us that in the short term, in the now, that price is trending pretty strongly. 5, it's trending hard. 9, it's still trending pretty hard, but not as hard as the 5. And then your 21 EMA, that's going to be your pullback support resistance. That is still, it's a middle ground between the 9 and the 50. So it's still short-term momentum is intact, but then it's also kind of a middle ground between the medium and the short term. So let's talk about some of these. So let's go over the 9 EMA first. So the 9 EMA here's here in the purple. So as long as price is trending above the 9 EMA, there's no reason to sell other than if you hit your 2R goal. So always scale profits that you don't let the trade go against you. So you see how this purple line is really just hugging price. So we had an ascending triangle, we got resistance, we got higher lows into resistance, and we get that breakout. What do? You ride it until you get a candle close below 9 EMA. So if this was options, it's been a massive trade. So the 9 EMA is a good way to let your winners run. So as long as you're above 9 EMA, you're good to hold. You have no reason to sell other than you hit your target, right? So what they do is they help you get the most bang for your buck and ride the trend. So this is the example that we use from our flag. So once we break below the flag, we can use the 9 EMA here as a point to take our profits. When we get a candle close above the 9 EMA, we can get out, whether it's a loss or it's a gain. The only thing is you have to have a lot of patience. So often what happened to me is that I would be watching the 9 EMA and I knew the rules, you know, once it closes above, other than that, you're good to hold. But once you see, you know, your option is up 100, 200, 300%, sometimes you just want to take it. But I should have stuck to the rules better. Okay. So you have some kind of setup here. Here we have our Fibonacci setup. So we have ABC, and then we have our, it's most likely a 50% retracement. Okay, and you short here, and then what do? You ride until price closes above the 9 EMA. Now here I went above a little bit, but since we still have this potential support turn resistance, I'm going to hold for a little bit longer. So you just have to use your discretion. I mean, that still would have been a good gain if you just followed it to a T. Okay. Skip that one. All right, same situation here. So say you took some kind of short up here. And then what would you do? You would ride the stock until price closed above the 9 EMA. Pretty simple. And then definitely, you know, you see this Mariposa here, engulfing candle. That's your cue. You know, you need to get out. All right. Here we have a symmetrical triangle breakout on NVDA 2-minute chart. So if I'm kind of being aggressive and I want to take this breakout, I'm going to use the 5 EMA here. So I've got 5 EMA in the orange and 9 in purple. So the 5 is the super strong, you know, short-term strength, right? So we know as long as we're hugging the 5, price is trending pretty hard. So as soon as it closes below the 5 EMA, then I might be out. Or what I could do is I could take half off when it closes below the 5 and then take the rest off when it goes below the 9. So pretty much I'm not going to long stocks under the 9 EMA, and I'm not going to short above the 9 EMA. And then I would really look at the 5-minute chart for this. The 3-minute and the 5-minute chart are going to be the best for this. So they're going to show you where is the short-term trend. We can actually combine these. So just like we had the golden cross and the death cross, we have the 921 EMA cross. So when the 9 EMA crosses either above or below the 21 EMA, it indicates a shift in short-term momentum. So here we've got bullish 921 EMA crosses, meaning momentum is shifting to a bullish trend. So here we have that trend break. And then we got our 921 EMA cross right at the trend break. So that's 2 reasons to take the trade. And then we can ride it. And then this 21, remember, it acts as pullback support. You could add some more here, or maybe that was your entry at the 21. What I like to do pretty much, since I don't like to be in trades all day long, I just like to exit when it closes below the 9. Just keeping it simple. But a lot of people will use the 21 as a pullback area. And if that fits in with your Fibonacci, so if you have fibs combined, they line up, with your 21 EMA, your 50 EMA, 200 EMA, whatever. That is another reason to add in your toolbox as to when or when to not take a trade. All right, so we have this channel right here. We get a 4-bar play as well as a bullish 921 EMA cross. Then we ride the momentum until a daily close below the 9 EMA. Or you can leave a few runners and then wait until it closes below the 21 EMA. Now, you can't buy every 21 EMA cross blindly. You have to have some kind of pattern with it. So there will be a ton of 921 EMA crosses, but you can't buy all of them. So here we have a trend break. Here we have a trend break with the channel as well. So you can't just fire off anyone. So, you have to look at your key levels. Are you reacting off a key support or key resistance? Are you in the middle of a range? See here, we're in the middle of a range. We got a bearish cross, then a bullish cross. Didn't really do much, but it just chopped you up. So you have to use these 921 EMA crosses in conjunction with price action. Sometimes you want to even get in before the cross. You can anticipate it curling. All right, see this area right here? See there's just not really any trending action. It's kind of in a range. And then we got this 921 EMA cross, and then it pulls back to the 9. You get a shooting star here. And then you could have went short and then hold until the 9 EMA is reclaimed. So that's a good way to enter in on a pullback. Sometimes it will flag into the 9 EMA. Sometimes it will flag into the 21 EMA. You just have to use your knowledge of price action in conjunction with the moving averages. The best way to use the moving averages is to just measure the trend. So what we observe from the 921 is that the momentum is shifting. So here's a great example from NVDA 5-minute chart. And that's what I recommend. Use the 5-minute or the 3-minute chart for this, or the daily. It works on any time frame, to be honest. But for day trading, 5 minutes is going to be awesome. All right, so here we got a 3-bar play at the open with the bearish 921 EMA cross. So the 5 cross, or the 9 crossing below the 21. And what do? You're good to hold as long as price is below the 9. So here it closed above the 9. So then we can take our profits. Here, maybe you would have gotten out because lunchtime would have eaten your contracts, but that's a conversation for another day. But there's no reason to exit as long as you're below the 9 EMA. So don't get scared out of your trades just because you see you're in profit. You got to let the winners run. And that is how you do this with moving averages. So as long as it's hugging the 9, we know the short-term trend is still bearish. And then here, we just got different EMA crosses, 921, boom, 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 boom. Some of them work, some of them don't. These lunchtime ones, I'm not taking those. Right. It's a pretty self-explanatory example. We've got a pennant here, symmetrical triangle, breaks below, and then what do? You ride until the 9 EMA is reclaimed. So once you have those pattern breaks, you can use the EMAs to help you with your targets. So look, every time it comes back to the 9 is rejected. Eventually it's reclaimed, but that's a good game from there. So let's talk about chop. So use moving averages along with candlesticks to stay out of chop or range-bound markets. So you see this range-bound market. You see how the moving averages are just pretty hideous, not really trending at all. So when the moving averages look like this, they're crossing all over the place. They look like they got hit by a train or something. That is when moving averages become useless for signals. Now it's useful in the sense that you know when to stay out of the market, but useless in the sense that you're going to get any kind of signal out of this. So you can actually view moving averages to see when price is trending and when it's not. So here, look how the moving averages are just kind of, you know, they're really choppy. They're giving you all kinds of crazy patterns and shapes. I mean, not that you couldn't see that from this price action, but if you needed to, you could. So they're useless in non-trending environments. Okay, so here, not trending, we're in a range, we're in this box, this rectangle. See how the moving averages are kind of stacked, not really giving you any kind of signal. So they're flattened here, indicating there is no trend. So avoid these areas. All right, what happens now? So let's look at some trending action. See how there's space between the EMAs? So you've got a good distance between the EMAs. So that shows you you're trending. So when price is hugging the 9 EMA, then you got space between 21. That's trending. That's stuff you can get involved with. You can look for opportunities there. You can look for setups in that kind of action. But see over here, there's no space. So when you're talking about trend versus no trend, chop versus trend, EMAs are flattened, no trend. Space between the EMAs, that's trending. And what's the difference between an SMA and an EMA? So the SMA, the simple moving average, are better for longer time frames. So the exponential moving averages, the EMAs, put more weight on recent prices to calculate the moving average. But to be honest, the difference isn't huge. If I put a 50 SMA versus a 50 EMA on a chart, it's going to be like a few cents, to be honest. It's really not going to be that big of a deal. So in my opinion, use 50 200 SMA, but use 5, 9, 21 EMAs. And obviously never long a stock below its 5, 9, 20-day moving averages, and never short a stock below. And then it's important to never buy on a moving average cross alone. Use multiple factors in your analysis, just like the Fibonacci we've been talking about, the patterns we've been talking about, the imbalances, the candlestick recognition. So you have to kind of be a detective, and you're looking for all these clues as to why or why not to take a trade. And here's a little roadmap. You know, the 5 is the strong, the 10 is the short term. I use the 9. The 20 is the pullback support. I use 21. Don't ask why I use 9 versus 10 or 20 versus 21. It's really not that big a difference. It's just how I learned it. So if you put 20 versus 21 right next to each other on the chart, you're going to see the same thing. 50 is the uptrend defense line. 100 is the big price dip. Sometimes I look at the 100-day moving average. Sometimes it does respect it, but not typically for day trading, just kind of on longer time frames. And the 200-day is the bull's last stand in an uptrend and bear's last stand in a downtrend. And 250-day, I don't really use that. I think that's more for like Forex and crypto people, where the price just goes continuously 24/7. And some advice from our friend Cher: do not get bagged. So just a recap: moving averages, tools to measure the trend and identify points of interest. 200 SMA, area of value. 50 SMA, medium short-term trend. Bullish MA cross, when the faster moving averages crosses up the longer-term moving averages, that is a bullish shift in momentum. So when the 20 crosses up the 50, or when the 100 crosses up to 200, or when the 9 crosses up to 21. And then vice versa for the bearish moving average cross. When the faster moving average crosses below the longer moving average, like the 200, or like the 50 crossing below the 200, or the 20 crossing below the 50, or the 9 crossing below the 21, that is considered bearish. And then the 5, 9, 21 are indicators of short-term momentum. So as long as price is hugging the 5, no reason to sell. As long as price is hugging the 9, no reason to sell. As long as price is hugging the 21, That's different. I don't really use the 21 like that, only to observe the shift in momentum. And then riding the trend. So how to maximize profits and minimize risk. So like I said, as long as those moving averages are intact, as long as price is hugging them and respecting them, you're good to hold. So that's the beautiful thing about moving averages, that you can really get the most bang for your buck, and you know when momentum is shifting one way or another. I take that back about the 21 EMA. Sometimes I use it for pullback trading. Like if I see I'm at like a 50% retracement at an FVG, and that also happens to line up with the 21 EMA on the 5-minute chart, yeah, maybe I'll use it in that way. So anyway, your assignment is to find an example of a stock with a market cap over 1 billion, respecting its 200-day moving average on the daily chart. So find a stock respecting the 50-day moving average. Find an example of a death cross in a weekly time frame. Find an example of a golden cross on a weekly time frame. Find an example of a death cross on SPY 5-minute, and identify where you would have entered a short on the pullback to the 50 SMA. Show me your candlestick. What is your thought process there? And find 2 examples of the 921 EMA cross on the 5-minute chart on Lucid, 1 bearish and 1 bullish. All right, so that's all I got for you tonight. So if no one has any questions, or if you got any questions, let me know. Otherwise, I'll see you next time. Thank you, AJ. All right, see you later.